Nifty has witnessed a 13.5% crash, a staggering 3,550 point correction, triggering a panic across the markets. However, the damage isn't just limited to 13% on this index. If we look at some portfolio stocks, you'll see stocks like this falling 40%, 20%, 30%, 40%, 50%, and so on and so forth, which is creating a lot of panic amongst investors' portfolios. To understand this, we need to zoom out and assess the bigger picture. So, looking at the monthly time frame here, since the COVID lows of March 2020, Nifty has been in a strong bull market. It's rallied 250% over the last 1645 days. Despite the long-term uptrend, market sentiment shifts drastically when correction occurs, especially when they happen rapidly. This is the largest crash in a while, and with the speed at which it has unfolded has intensified the fear. So looking back at the last three crashes is the September 2023 to November 2023 crash, wherein we saw the markets fall for a small period of 2-3 months from the high of 20,222 all the way to the low of 18,837, where everyone was expecting markets to go to single digit figures and this and that. It was a 7% correction of about 1,500 points back in the day, but then the markets turned around from there because we are in an ultimate bull market, something that has not occurred in ages. Like, just to give you perspective, from COVID lows, we've seen a 250% move, which is similar to the move we got over the span of about 4,000 days from May of 2009 to the COVID top, that was Jan 2020. And when we do something like that, in half the time, in just 1,674 days, that is from the COVID low to the current all-time high, we need to be ready and anticipate such corrections and learn how to navigate it, because the bull market could still continue or it might die, and you need to still know how to position yourself if it dies. So looking at the second data point from the past of corrections is the December 2022 till March 2023 correction, where we saw Nifty fall 11% or 2,000 points from its all-time high of 18,887. And as you can see, the confluence over here, wherein you have this high of breakout or a resistance point be the support of the next crash that we just studied, the 7% crash. The low of the 7% crash that occurred in 2023 was 18,837, really coming close with the high of the previous crash that was 18,887. So you need to understand that no matter how much the panic is, the rules of demand and supply, support and resistance stay consistent. You will find support at a prior resistance zone. At times it may not occur during panic and this and that, but most of the times we need to put our trust into this and put our money where our mouth is. That is in technical analysis, because as true traders, we are analysts. We need to have the belief and conviction to take trades on our analysis. And the last data point is the worst one, which was the 18.5% correction of Nifty in the year 2022, which started from the October of 2021, from the high of 18,604 all the way to the low of 15,183. That was an 18-point correction, and it was the longest period of short in a long time. It took 250 days. From there, the markets then turned in July of 2022 till the next correction that we just recently saw. From all of these data points, we learn to understand that the markets normally seem like they are coming to an end. And personally, being in the market for more than 4 years at this point, I can clearly tell you that I have experienced these phases very clearly, and so may have you, that you know how the panic happens. You know how everything seems like it's going to lose, and then the motivational quotes start that, you need to not put money in a falling knife and this and that. But we need to understand that this is not a falling knife. If you come up on the higher time frames, you can clearly see that every time of these periods, like the COVID lows or these three significant crashes that I just presented to you, you will notice that the markets eventually come back in its trend and start rallying no matter how bad the correction was. May it be a 7% or an 18.5%, or if we're talking about COVID, it was a 40% collapse. So the best bet we can take is to learn how to navigate these if we are intraday traders or swing traders. But at the same time, when we look at portfolios that move up 40, 50 and 70%, now with the age of technology that we have the ability to see our portfolios on a regular basis, it gets difficult to navigate that essence and position ourselves to not exit our long-term investments even through periods of crash or pullbacks or corrections, and be open and willing and available to play out this beautiful bullish market and the Indian narrative, or at the same time learn how to navigate it through the red times. So now let's zoom into the daily time frame and analyze how we can position ourselves to capitalize on the short-term trend. So looking at the daily time frame, we can easily see around the 3rd of June 2024, the market broke out of 22,800 and 23,000 zone that is currently acting as a support level. This was the election breakout rally when Nifty surged 3,200 points or 13.9% in just a short span of 112 days. Momentum peaked on September 26, 2024, which is the spot from where a major downtrend began. From September to December 2024, Nifty fell 10%, briefly bottomed during November end to December and gave us a short-term bear market bounce of 6%, only to then crash again by mid-December. We could still monetize off the 6% of a bear market bounce because these bounces have really good momentums. Like 6% in itself is more than 1,000 points. And if you get 1,000 points on even one lot of Nifty future, that is a significant gain. From the past 3 trading sessions, we have shown a strong price action with lower price rejections at this key level, that is the election breakout level. And this is as of February 19th, 2025, 11:30 a.m. An important pattern that we need to be aware of throughout all of this is that the Nifty is currently creating a chart pattern which is a textbook head and shoulders on the daily time frame. So as you can see, this is your left shoulder, this is your head, and this is your right shoulder. That was the entire December market bounce that just happened. So typically how these head and shoulder patterns function, the distance between the neckline and the peak of the head is normally the target on the bottom side after a breakdown. And we have certainly seen a breakdown. And maybe the current market bounce could just be bull trap, and it could just be a retest of the head and shoulder pattern that could eventually lead us to targeting this potential drop of 2,861 points, which aligns with a 12% downside target at approximately 20,500. However, this isn't set in stone. It is not confirmed and it is not guaranteed. This is just technical analysis giving us a signal, a signpost that this is highly possible, as this is how the markets usually function and how this pattern functions. Now, we have seen similar things in the past wherein the markets have fallen, but 2025 is certainly different with the bull market narrative. While technical patterns suggest further downside, the fundamentals of 2025 remain bullish. Interest rates are dropping, Donald Trump returns to power, Narendra Modi's third term, and overall economic optimism. However, even in bull markets, corrections are ultimately necessary before assuming an uptrend. Like we saw this entire uptrend of our markets, it is important that the markets now see a reversal correction so that it can prepare itself for a new upside momentum. So key levels to watch, being prepared for both the bull and the bearish case. So looking at the bullish scenario, a closing above 23,100 in itself will potentially create a larger possibility to 23,200 and all the way up to 23,300 and then 23,500. That's a 4% move with the confluence of 50 and 200 EMAs present at that level. Then from this level, we may either face resistance and we need to prepare ourselves for a rejection, because ultimately the market is still in a bear market situation considering the last few months. But this could also be a turnaround, hence we position our trades to allow us for that. Then we could see the potential move continue to 24,208, which is a major resistance level but at the same time could be a turning point if momentum continues. And we will recalibrate and reanalyze from that level. Now, coming on to the bearish scenario, if Nifty fails to hold this support as of now, intraday and over the next week, in this entire week itself, on the weekly time frame, we need to prepare for short positions and we need to prepare to position ourselves away from the market. Let your SIPs continue as the market is in a really good bullish phase, and you may get a bottom come down somewhere around previous lows as we saw 20,500, or you may choose to sit out completely. It is your own decision. So if Nifty fails to hold support and closes below the recent lows on the daily time frame, we will firstly considerably change our intraday trades from using call options to sticking with put options for intraday momentums, and we will convert our BTST future longs to BTST future shorts. Position trades that are aligned with the head and shoulder breakdown pattern with a target of 20,500, and it may go even a bit further below, or it takes support a bit earlier. You need to be aware, like 21,800 is a really important support level. So it doesn't mean that these patterns will exactly give you your targets like the head and shoulder, but it may lead to those, or it may just turn around from here. Anything goes. We just need to prepare ourselves for the best. So the conclusion is that the market is at a make or break state. A strong breakout could lead to a new bull phase, whereas a breakdown confirms the bear case targeting 20,500. As traders, we must be aligned with the levels and technical analysis and not predict anything, but align with the price action and execute accordingly to our plans. This is it for our breakdown. See you in the next video.